Hey guys, on today's episode, we're gonna take a look at Dave and Buster's and see why it dropped 20% after earnings. We'll take a look at earnings call, earnings files, and see why investors started to sell off this company. So let's begin. Alright guys, so like every episode, I already took the time to read the 10Q report in this one because it's quarter one. I also took the time to look at their earnings transcript and any other information that Dave and Buster provided for us during their earnings. So as we saw, Dave and Buster dropped about 21%, a little bit over $10, and is sitting right now about $40. So let's take a look at what happened. And first, let's see, down over 16%. I feel like these are the top few reasons that they dropped. First, they report comparable sales fell 0.3% in Q1, and it fell short of its expected 1.6 gain. With this decrease on quarter one in comparable sales, it made Dave and Buster's full year revenue swish. They also lowered their full guidance for this year, which again is bad news. So from 1.365 billion to 1.39 billion compared to 1.37 to 1.4 billion prior to these change. So we can see it's about a 0.5 to $1 billion difference in guidance compared to last year. So the actual number does not seem to probably be scaring the investors as much. It's just the fact that they had to change their guidance. Having to change their guidance means that for me, in fact, it means leadership was not prepared for all the upsides and downsides. And here it shows that they were not prepared for what could happen. I feel like leadership, when they do give some form of guidance, they have to put in fact everything that they know might have a possibility of happening. And they did know that quarter one is volatile due to the shift in Easter holiday. And this is the reason they're blaming this shortfall. But they knew Easter was coming, and looking at their earnings call in the transcript, they mentioned that they knew quarter one is a volatile quarter. So if they knew it was a volatile quarter, then they means they should have known that their revenue would have been extremely volatile based on quarter one. So to me, that kind of shows a really lack of leadership. Full net year income of 103 million to 1013 is anticipated versus 105 to 117. Again, net income, just like their revenue, obviously if they're collecting less revenue, they're also going to be collecting less net income. So those are just some changes. So now let's take some key highlights from the first quarter of 2019 compared to the first quarter of 2018. So these places like these seem to be seasonal, just right. Summer probably tends to be a better time for them because there's more kids out of school and more adults are definitely out to take their kids, and the adults themselves are also able to go out more during the summer opposed to winter time, where here in the East Coast we have snowstorms and other weather related activities that can postpone us from going to stores like this. So that's why I like to take a look at information compared to the same quarter last year, because it'll be more of a one-to-one ratio, because the same holidays are happening, the same types of weather storms are happening, so the same type of volatility should be happening. So total revenue increased 9.5%, almost a 10% increase, and that's definitely really good when we're seeing quarter to quarter. They opened 7 new stores compared to 6 stores last quarter, so an extra stores, and the company is still growing at a great rate, it seems. And I will take a look that they're even wanting to open, I think, a total of 15 stores for this year. So they still have about seven to 8 more stores to open. Unfortunately, comparable sales decreased 0.3%. So this is crazy, right? I mean, that's how you can tell a company is growing, because even though comparable sales decreased, that means same store to same store sales decreased, they're opening new stores that are allowing the revenue to keep increasing. Unfortunately, eventually you'll have a point where once you flatline in new stores, you'll be able to really see if the new store, well, right here we can see the stores are not producing what they should be producing. Net income of $42.4 million, or about $1.13 per share, versus net income of $42.2 million, or $104 per share. So we can see a nice small increase of $0.2 million, not a lot, $200,000 in net income. That for a big company does not seem like a lot of money. in my opinion, right? Earnings before income tax increased 3.2%. Adjusted earnings before income tax increased 2.4%. They did launch new games, so Marvel Contest of Champions and Star Trek Dark Remnants, their third proprietary virtual reality titles. So we can see they are investing in new games, and they're definitely going with the trend. Marvel has definitely been a great big thing going on in the entertainment realm. So they got this new game on it. Star Trek, I'm not too much of a Star Trek fan, so I wouldn't know, don't follow the series that much. But if they, I'm pretty sure they do have. We have a lot of fans of the Star Trek that would love to go and play this game. They did repurchase 1.3 million shares for 63.5 and paid a quarterly cash dividend of 15 cents per share. So now let's take a look at their revenue. So they delivered robust revenue and earnings per share growth, and new store performance remained strong. So yeah, we saw right there was a 9.5 compared to the same quarter last year increase in revenue. The revenue growth was driven by 11.9 increase in amusement and other revenues and 6.1% increase in food and beverages. So you can see more people. There's still more people. There's still plenty of customers going to Dave and Buster's to play because revenue has increased about 12% on just the gameplay. But their food and beverages are also doing good because it did increase by a nice 6% as well. So those are some strong numbers for a quarter to quarter base number growth. So that's definitely really good in my opinion. We can't expect anything much higher than that. I think would be pretty impressive, but I don't think it's feasible for a company at this size already. And just to break down the mix, amusement and others, our percentage total increased 1.3% to 59.2%. So amusement now is 59.2% of revenue, while food and beverage is 40.8. Both have grown compared to the same time last year, so that's definitely good news, right? Even though so if revenue is divided into two things, it's divided into amusement and it's divided into food beverages. If amusement has gone up based on total revenue, that does not mean that food beverage has gone down. Food beverage has also gone up, but the actual percentage of sales, amusement has gone up much higher. But that's definitely good that we're still seeing a both growth in food and amusement. And to me, it's pretty impressive that food and beverage. I definitely think the beverage, but the food to be about 40% of this total company's revenue is definitely pretty impressive. I thought amusement would have had much more higher percentage compared to total revenue, but it's close to it could eventually get to a 1-to-1 ratio. But I'm pretty sure maybe the obviously the amount of money you pay for revenue can probably equate the amount of money you pay for food. Um, so yeah, next we'll talk about increase in costs. They did have some increase in costs that we're gonna see. Operating and payroll benefits increased about 20. Cost of percentage sales was about 22.8%, an increase of 90 basis point compared to year over year. And so that means last year was 21.9 because 90 basis points is an increase of 0.9%. So it was increased due to unfavorable impact of wage inflation. I'm sorry that income had to go up. I'm so sorry for you, Dave and Buster. Incremental investment in labor related to virtual reality and deleveraged on comp stores. So we can see they are investing in virtual reality. But to me, I'm not 100% sure how that will work. I have gone to Dave and Buster's a few times last year, and the virtual realities are games I usually don't tend to go to. They do take up a huge amount of real estate in the stores themselves, and maybe it is because I have virtual reality at home that I don't really see um the big fuss about it and going to go pay for it, and they are a little more expensive than the regular games. But hey, I wish we could see what percentage is going to virtual reality in form of income, but I don't think they break it down that low for us. They also have a deleverage on comp stores. Other operating expenses were up 100 basis point year over year, largely driven by higher occupancy costs, primarily at our non-comp stores and increased investments in sports programming. So right, it's saying that they had it. This is weird. The way they try to word it, it makes it seem that they're higher people coming to the stores. So that's why their operating expenses have gone up. Then they meant that this is primarily on non-comp stores. So non-comp stores are stores that just opened up in the last quarter that they can't, in the last 3 quarters that they can't compare sales with this quarter. So even it doesn't really mean number of people have gone up. It's just that since they now have new stores, obviously they're gonna have new customers in these new locations. But they can't compare it to the same location because that same location was never there. So this we have to again continue to wait to see once these occupancy these new stores start to slow down, so we can really see how the occupancy is going on. So right now we don't know how we saw that there was a 0.3% decrease in comparable sales. So technically we are seeing less customers going into same stores compared to previous quarter. General and administrative expenses were 6.8 million, up 7% from the prior year, reflecting increase in supporting a growing store base and higher technology and legal expense, partially offset by lower stock-based compensation expense. Again, this is investments that they need to do, and these expenses are not outrageous. They seem to be pretty fair based, and the amount of increase is not happening as high. And remember, we are opening about 6 to 7 stores per half a quarter, per half a year. So we do expect to see these expenses go up. Next, we have the guidance for 2019, and they are revising on key metrics for fiscal year of 2019, which ends on February 2nd, 2020. And this is the main reason I think the stock dropped. So in my opinion, right, like I mentioned before, this shows a lack of leadership. As later on, we're gonna see that they mentioned that they knew quarter 1 is a volatile quarter, so they should have planned ahead. Like I mentioned, they did total revenue revised. So yeah, total revenue of 1.36 billion to 1.3 compared to 1.37 to 1.4. So these are actual numbers taken off from their transcript. So we can see the actual number is not that big of a difference. It's about $10 million. $10 million is not huge. And comparable sales, this is the one that's again a big thing. Comparable store sales of negative 1.5, 2.5% compared to a flat 1.5 increase. Comparable store sales. So that means they are still worried that less people are gonna be coming to their stores. I mean, from a flat 1.5 to now negative 1.5, that's a huge range gap where they switched over to. And here we can see that it's definitely not a great thing to see in same stores, same store sales decrease by that amount of money. They are trying to open about 15 to 16 new stores. That's left unchanged. Net income of 103 million on the low range now compared to what they thought was to be 105 million. Again, that is not a huge difference. And I don't think the actual number values of decreasing about $2 million is making this stock drop 16%, but it's that comparable store sales of negative 1.5 that's definitely scaring the investors. Any other big change that I can see? We can see right earnings before income tax were previously 285 million in the low range, and now it's 283 million. Only $2 million difference. So we can see this, in my opinion, the number value is not like I keep repeating, it's not the main factor of this drop. It is just that comparable store sales decrease, and just the fact that they had to do guidance, revising on their guidance. So we had some top dog shifts, so some new people joined. We have Scott Bowman, who recently joined as the CFO of the company. Scott does have a long proven record of success working with brands like Home Depot and most recently Hibbett Sports. Joe DiProspero was serving as the interim CFO, but he is now the SVP of Supply Chain and Business Development. So that's pretty good that they had the new SVP of Supply be a previous person inside. So I like to see upgrades within, because those are the people that truly know the company as a whole. Scott Bauman did not know the company, doesn't come from inside the company, but he does have a resume, a pretty impressive resume working for those two big companies. So that'll definitely be good. And see, Home Depot is definitely a good company to experience similar attributes that can definitely be used in this type of work. So again, these top dog shifts to me, that nothing too heavy right now to really worry about. Shareholder returns during this quarter, they repurchased approximately 1.3 million shares of common stock at an average price of $49. So right now you can buy the stock about $9 cheaper than they did. So that's they're bad investors. I mean, I these people are horrible investors, if I may say so myself. But they currently have over $200 million for remaining under the existing authorization. So I wonder, with this big drop, are they picking up new shares? Since inception, they purchased about 7.6 million shares on average price of slightly under $52. So I mean, they're definitely way above their the stock price is way below their average price point. It's about $12, and right now that they need about a 30% jump to get to where they purchase shares. Um, so I wonder if they're going to continue to buy some shares right now. So they spent about $63 million. So they spent about $63 million to buy those shares, and they currently still have 200 million. So yeah, they can still buy plenty of shares at this current price. Hopefully, they are buying. They did pay their third quarterly cash dividend of 15 cents per share during quarter one. And pretty new for me to see that a company has only paid cash dividends for 3 times. So they definitely paying this amount of cash dividend. It definitely shifts the whole money movement, cash flow of the company. So they're fairly new at paying cash dividends. So I wonder how effective they were at definitely at allocating this money and making sure they're still paying, still have enough of positive free cash flow to continue with their business. So this is what we'll see in the next episode, where we'll take a look at their numbers. But this is pretty early for them to be paying cash. Not early for them to be paying cash dividends, but it is early in their cash dividend payments. Right. This is the third time they paid cash dividends. So it definitely shifts the whole momentum of the money flow, and it's something to take a look at. Right. Is it working out? Are they going to need to? Can they increase it? Are they going to decrease it? And after a few quarters, they definitely get to see the true effect of what's happening here. Things to note from the earnings calls, like I mentioned, I did read their earnings transcript, and I love reading their earnings transcript because we get to see what leaders have to say. And the earnings transcript, even though they practice already what they're saying, they definitely get hit with some curveballs that can definitely change things of how they say stuff. So this is the thing that confuses me at the most. As mentioned on the last call, quarter one tends to be volatile quarter for them due to the timing of Easter and spring break and the impact of weather during the specific time period, and this year was no exception. So they knew that quarter one had a volatile type of revenue source. So that's why I don't understand why their guidance was so bad. I mean, that to me gives me a bad taste on leadership. They should have been prepared for something like this because they knew. They even mentioned it last quarter that quarter one tends to be volatile. They do expect increase in competition over the balance of the year as they continue to see aggressive entry into their market. Another reason why we're probably seeing that decrease in comparable sales, and again, that's another one. I totally forgot that I read that one, but that is definitely another reason to see that drop increase. I mean, they're saying they are seeing aggressive. They're using the word aggressive entry into their market. You don't just throw out the word aggressive out there unless it means that it can truly influence something. So they are seeing that type of entry into the market. And another recent key point to keep note of. Like always, they are trying, like any other company, the main thing they try to do is improve experience for their customers. If you improve the experience for the customers, that means the customer is going to be returning. Like, for example, for me, I've gone to Dave and Buster's, but I'm not a fan of the restaurant. I go for the gaming and the drinks. But the restaurant always gave a bitter taste to my mouth, so I never really returned to it. And that's because of that I didn't have that great experience. So if you improve the experience, you'll continue to get the customers coming back. So they are increasing the amount of new games, including multiple proprietary VR games. Like we see, VR games are definitely something they are focused on and are investing in. Turning to the food and beverage business, they remain on simplification of quality and accessibility. They did decrease their menu by 35% compared to the beginning of last year. I mean, I think that's definitely a great news. I forgot when was the last time I went to their restaurant, but they did have a big menu, and a big menu doesn't help out as much. So they reduce with complexity in kitchen process and improve the ability to deliver items quicker on busier nights. Again, that food and business, we can see why it's definitely holding about 40% of the total revenue. They are on track to unveil a new mobile app in the back half of 2019. So that's probably sometime around fall. Business, they do say that their business must remain digitally relevant to attract and retain our core customer groups, and their new assets being designed to offer greater functionality. I kind of wonder what kind of access will this application have that would allow customers to come back and that will help out grow new customers. They still haven't given details about the true what this application can do, and they say later as we get closer to the release date, they will mention some of the applications this software can use. They do continue to believe international represents a good long-term growth vehicle for them, and they will continue to pursue potential opportunities. At the moment, I believe that the only two places they're in is United States and Canada. They did try to do someplace, I forget. They did mention that they are pursuing other locations, international, but at the moment they did not talk much about them. So it's something I can probably take a little deeper look on later throughout the series. Like we can see, there is that new standard lease where they have to recognize of operating leases that are longer than 12 months. So right now it added up about $880 million to their assets and about $1.1 billion to liabilities. So if you're looking at companies right now, if you're starting to look at their assets and liabilities in their balance sheets like I normally do, you're going to see that all these companies in this past quarter have increased their liabilities and assets dramatically. But we understand that this is because of the new lease standard that they have to represent these liabilities and assets. So you just got to make sure that the increase in liabilities and the increase of assets kind of match the numbers we see here, because if not, it can throw us a red flag. So that's it, guys, for Dave and Buster's. Tune in tomorrow for a new episode. We will take a look at their numbers. Don't forget to subscribe, guys. Let me know what you guys think about the company in the comments. What are your current thoughts of Dave and Buster's? Do you think this 16-20% decrease is definitely has a right to be drop that much percent? If not, are you buying? Are you selling at this time? Are you not even looking at Dave & Buster's? Let me know what other company you want me to take a look at, and make sure to give me a subscribe and a thumbs up. Take care, guys, and see you tomorrow.